So joining us now is Victor Adair from PI Financial, who is the derivatives portfolio manager over there. How you doing, Victor?
I'm doing great, thank you, Kev.
Oh, that was Patrick, but that's all right.
It's okay. You know what, Victor?
Okay.
A lot of people can say they can't tell the difference between us.
No,
It's all right.
it's all good. But listen, we wanted to get you on because we wanted to pick your brain as to what's going on here in the markets. I mean, one of the things that you were highlighting was this key turn point that occurred back in September. I think it's a great place to start this conversation. So what did you exactly see and what's on your mind?
Well, a number of markets turned right on or about the 3rd of September. I mean, the key one that got my attention at first was the bond market. I mean, that was the day that the U.S. long bond traded at its lowest ever yield, and then yields started to rise from there. But the thing that made it just that much more interesting, and I noticed this like a couple of weeks after the fact, was that a whole bunch of other markets also reversed right on about that same date. And when a whole bunch of markets move at the same time, it kind of makes it just that much more significant. In other words, the inflection point to me becomes that much more powerful. Now,
Right.
I mean, and then as time has gone by, I've seen a few other things. I thought, gee, I missed that. For instance, the British pound had a multi-year low right on the 3rd of September, and it turned. The German long bond was turning right about that same time. And I wondered, what was the center of this turn? If it was like the British pound, it was maybe the easing of Brexit worries. And then, as you trade as well, when things are moving in the market, like you drop the pebble in the pond, it ripples out. So like everything gets affected to some degree. So on my website for the past month or so, I write these weekly notes. And I've just been going on and on about the key turn date. And I guess the real big thing here is I'm saying it might be the polar opposite of 1981 when interest rates were really, really high. Remember at that time Canada came with a 15% yielding government bond. You couldn't give it away. People thought inflation was going to go on forever and so on and so on. So now people, are so desperate to own bonds, they're willing to buy bonds that are deeply negative. So maybe it's the polar opposite, and
Victor,
why that's important. Yeah.
You know what? You got to see the smile on Kevin's face because this is like music to his ears. And
I knew there was a reason we got Victor on.
For sure.
Victor, I couldn't agree with you more. And it's interesting that you noticed the date that all these things turned, and you mentioned a few different kind of potential, let's say, asset classes or securities that might have led it. I'm actually of the belief that it was the German Bund that led the move upward on all these yields. Yeah. Oh, so you're the same belief. Why do you think that?
Well, because it was the let's say it was the Europeans and the Japanese that created all these negative yields. I mean, really, nothing else matters if you take them out of the equation. And like the epicenter of it was about the German bond, and it just got to that point where it wasn't going to go any lower. They started talking about maybe instead of driving negative rates deeper and deeper and deeper, the ECB, that maybe it was time to pass the baton over to the governments to do fiscal stimulus. What a great time to issue bonds when you get paid to issue them, and that sort of thing. So, but here's another barometer. Both the euro yen and the euro Swiss turned on that same day, with the euro rising relative to those other currencies. The euro Swiss is kind of the barometer of, call it the fear and trembling in the European market. Swiss gets bid when everybody's worried, and on the euro it suffers. And I think the same thing with the euro yen spread. So a lot of things happen on that date. If it is the polar opposite, what's important to me as a trader is that all kinds of positions have been built on interest rates are going to stay low. And if interest rates don't stay low, then those trades are mispriced, right? And I want to get in front of people correcting that mispricing.
And so you think it's a secular change that is as important as those early days in 81 when the long bond topped out at 15%? Like you're thinking that summer rally in bonds, the the interest rate bid that just seemed to be without end all summer long. That was the kind of the buying climax. Is that what you're kind of? Is that your going assumption?
Exactly. When I look at, I even posted a chart where I just showed, let's say, July and August. In August, the market was just, the bond market was just gapping higher. It looked like, the juniors are on the desk, the senior guys are away for summer vacation, and people are just throwing in the towel. The bond market just raced away to the upside, and there you go. Now, in terms of, is this the secular turn? I'm just saying, it might be. As a trader, I want to try to imagine if the world is different than what it is now. And, this is one idea. Now, if the bond market continues to rally, I'm not going to stand in there like a dummy, with a short position and say, I know I'm right and the market's wrong. I'll be out. But, this is, if I can find something like this and then it starts to put some meat on the bone, then I'll run with the trade.
Okay, so what are you looking for on those meat on the bones? Like, what are the type of confirmation that you're looking for, and what are the best ways to position for that going forward?
Oh, I'm so glad you asked me that question. I mean, the last couple of months, I've been shorting Treasury notes on and off. And by on and off, I mean, I'll take a position, it goes my way, I'll take it off, market will back up, I'll put it back on again. But the other trade, and this is like the derivative that's really got me interesting, is gold. The gold market ran up about $350 from November of last year to the key turn day on September. It turned the same day. And I think gold during that period of time wasn't paying as much attention. It wasn't being affected as much by the U.S. dollar, which is usually the flip side of the gold market. But I was paying attention to real rates. Real rates just kept falling. And as they kept falling, the gold market kept rising. As the gold market kept rising, more and more and more people kept buying it. And I think as much as the people out there that are gold bugs, a lot of them hate what they call the paper gold market. That's COMEX. COMEX sets the price. There's just enormous leverage that people can use there. And that is like the center of the universe for setting the price of gold on a short-term basis. So I've got this huge open interest in gold relative to what it's been, huge bullish positioning by the speculators. So if the price of gold starts to roll over, as it has, it's off about $100, and I see now that open interest this past couple of days is starting to fall off some, gold may be a great short. And by that, I'm not saying it's going to go to zero, but I mean, if gold falls off $50 or something, I mean, that's a real worthwhile trade for me.
Yeah, so you basically think this backup in real yields hasn't been completely reflected in the gold market yet. It hasn't corrected enough based upon the move in the bonds. Is that kind of the line of your thinking?
Yeah, and I think maybe something I like to do is I try to find a market that's unbalanced. And I think but just come back to gold then, there's been this massive embracing of the bullish thinking on gold, and people are in there in the futures markets. And as the market has run up over the course of 10 months or so, and they've been, they're right. And when you're right and the market's going up and you add and you're using more leverage. So, but at some point, if the market starts to back up, those guys turn sellers. And if they turn sellers, it accelerates the downturn. So I don't think we've seen the selling yet in gold, and maybe it'll never come. I mean, I could easily embrace the argument that, some point out in the future from now, gold's a lot higher because the world goes crazy. So maybe those guys have got their eye on a longer-term time frame than me.
So, Victor, on the screen there, I have the shot of the long bond with gold overlaid on it. And the correlations have been very evident, hence what you were talking about there. So in general, the takeaway I would have here is that you think bonds will continue to weaken, and then gold will more or less stay within this correlation and continue to weaken with it on this cycle. Now, what I wanted to ask you, first of all, is that correct? Am I assuming right what you're sharing with us?
Yeah, that would be the thesis, and if it doesn't happen, it doesn't happen, and I'm not going to lose a fortune if it doesn't happen. The bond market. Yeah, Go ahead.
So yeah, sorry. No, the question I have for you is all about time frames, right? Like, so now a backing up of gold of, let's say, $50 to the downside, and Treasury bonds taking one more dive lower can be even a short to intermediate time frame move, right? But at the same time, the idea that we've saw this massive turn in September 3rd, that's a real big picture call, like that's a multi-decade call, even arguably.
Sure.
And so, like, I'm trying to sort of match together what your sort of roadmap is for the most intermediate term. Like, if we do see the further weakness, which is on both of these markets, do you think we're going to see some short-term lows? Like, how do you think the long bond reacts if we, let's say, have the Fed, for whatever reason, continue cutting, right? I mean, everyone's still on the fence as to whether or not this was a mid-cycle adjustment, or whether we're in a new cycle of Fed cuts that, as they're going to go down to zero. Whether that happens or not, as the long bond goes, as the short bonds go, do you still think the long bond is where that they just won't participate, that the long bonds peak is in, irrespective of what the short interest rates do?
You know, it could be if in fact the long bond is going to say switch from, we're in a recessionary environment. That was kind of the thinking, I think, that was going on this summer that really helped take prices way up, helped drive the total of negative yielding debt to the $17 trillion threshold. And that seems, the past couple of months, that thinking about where the narrative that we're falling into a recession seems to have quieted down. I don't know. I'm not going to pretend I'm an economist. I know I don't know what's going to happen in the future. I'm just thinking in terms of possibilities here, seeing that correlation. And I think with the gold, there's one more thing that's coming in. I did say, when the gold was having that long run up from November of last year to the September high, it was not much focused on the dollar. It was much more focused on rates. It's been my experience over time that just as you figure out a relationship between a couple of markets, the relationship changes. So maybe the gold market doesn't stay tied too much to the bond market, although I think it will. But maybe if the dollar gets some strength, or let's say the other currencies weaken. And just a very quick segue there, there's a thing I'm calling the stealth strength of the U.S. dollar. We watch the U.S. dollar index, it's what the composition of that is. The stealth strength I'm talking about is kind of like the off-the-run currencies, the emerging market currencies. For instance, we had the Brazilian real drop to a new multi-year low today.
Right.
I'm short the Mexican peso as a possible contagion play on what I see happening in the South American currency markets and economies and so on. So maybe the U.S. dollar strengthens, and that puts gets the gold market knocked down a bit. What I'm focusing on with the gold in particular is just this perceived vulnerability that there's a lot of people long, and a lot of them are already underwater, where you see where the open interest has been added the past few months. And if the gold market, for any reason, was to go a little lower, we might get those guys throwing in the towel, and that would accelerate the move.
So, Victor, Kev here. So we have the bonds backing up, which means the possibility the gold might get weak. What are some other trades that you're looking at as a kind of a consequence of that September 3rd kind of turn in markets that you saw?
Well, I wish I knew why the markets turned on that date. We talked moments ago that, maybe the epicenter was the German Bund, and I could see that because of the changing in the guard at the ECB with Lagarde coming in. I'm trading other markets. I've had some positions in the WTI market. The Canadian dollar, I've been shorting Canadian dollar. There, I think Canada is more likely to be cutting interest rates than the U.S. Wild card there perhaps is the USMCA, as they refer to it, the new NAFTA. And as I was saying to Patrick before we got started here, from time to time here in the past month or so, I've taken some short positions in the stock market. most of them have turned out to be losers. So, I just, I mean,
So
one of the
okay,
things that I was
so
saying to my son, yeah.
sorry, I agree with your Canadian dollar weakness call, so you should be warned by that. But,
Oh dear.
when we all agree on this show, it tends to work out on the contrary. But you did mention crude, right? What's your thinking on oil here?
What I've noticed is a lot of times crude, the WTI, and let's just say the WTI and spoof turn on about the same date. Like they turned at the same time in October of 18, both went down. They turned at the bottom in December, went up. And there was a couple of other turns, this spring. I'm forgetting without looking at the chart. But
I'll pull it up
I
over here.
did notice that actually from about 6 weeks ago, we've had a bigger percentage gain to the upside with WTI than we've had with the stock market. And in that sense, the stock market has outperformed. But if I could just finish one point on the stock market, I remember saying to my son, Drew, who works with me, it's got to be 4 weeks ago anyway. I said, if this stock market makes new all-time highs, there's a lot of people that are going to have to buy this market. I think there's a lot of money managers out there who are cautious about the market right now. They got maybe more cash than they might have otherwise, cautious for good reasons. But given that, there's way more money in the market that is managed by people managing other people's money than what individual traders are doing, and those managers have got to keep up with the Joneses, or they're going to lose assets.
Career
and I think
risk.
that sorry.
Yeah, I was just saying it's career risk for those managers, and if they're underweight, then they're underperforming, and they have to chase, right?
Yeah, exactly.
So, do you think crude oil is heading higher? Are we going north of 60? What's your intuition here?
I don't know. When I look at markets, I imagine possibilities. I mean, we had that spike right on the attacks on the Saudi facilities. The market came back. We've made some lows. What was it, around the $52 level? We've made that 2 or 3 times here the past couple of months. I'd say, other than something that's peculiar to crude, the OPEC meeting and so on, that the crude market's more likely to follow the stock market. So, and I don't know where the stock market's going, other than I think it's pretty rich, and we're vulnerable to a setback. So, I guess not having a position, I'm comfortable with that. If I want to take a trade if I've really got an opinion, and I'll have a strong opinion, or as Dennis Gartman used to say, a strong opinion, but just weakly held.
Well, Victor, it's Kev here. I love your letter, and I love the fact that you are a true trader at heart. That is one of the things that kind of strikes me the most about your analysis, is that you're not tied to something. You're not sitting there saying, I know which way the market's going. You're just dealing in probabilities, and it's a terrific kind of mind frame to have in terms of setting up trades. Why don't you leave us with just one more kind of setup or an idea that you might be having for the next week or two, or maybe a little bit longer, whatever it is. Just one last idea for kind of listeners to get an idea of the kind of trades you like to do.
Yeah. Well, I guess I've talked enough about gold, and at the very moment, I don't have gold on. I started today with a short position, didn't like the look of it, traded out of it. One of the things I think is you got to keep the time frame of your analysis in sync with the time frame of your trading. So, I mean, that'll wiggle around from time to time, but sometimes I'm looking at something and just say, I don't like the way that feels. So, okay, just dash it out, get rid of it, just go to the sideline, and then maybe you get more clear thinking. If you're hanging on to something, waiting for it to inevitably turn in your favor, that almost always goes bad. So I'm curious about what will happen with the U.S. dollar. The trade, I guess, that I have on that I'm really interested in right now is this short Mexico. Again, there's been a big buildup of bullish positions in the Mexican peso over the past couple of months. If the peso was to start, the pull of gravity from worries that so they're in recession. Maybe the country is ripe for some contagion coming up from South America. I think the Mexican peso could take a little tumble here. So
Well, that's a great.
that's something I'm watching.
That's a great trade to leave us with. So, Victor, for those who want to learn more about what you do, and I highly recommend that everyone subscribe to Victor's weekly notes. It's something that I get on my inbox and look forward to every weekend. Where can people find it and sign up for your weekly kind of what is it, a newsletter? What would you call it?
Yeah, what I call it my trading desk notes. I do a radio show out here in Western Canada with my good friend Michael Campbell, and we've been doing this for years and years and years. My website is polarfuturesgroup.com. Everything on there is free access. I write my trading desk notes usually on a Friday, post them Friday evening, and then I use them for the dialogue, the Q&A that I have with Mike every Saturday morning on the Money Talks radio show. So polarfuturesgroup.com.
Great. Well, thanks a lot. Thanks for being with us today, Victor.
Hey, it's been great, guys. Super.
And for everyone, please stick around. Victor's going to be joining us in the after hours to continue his conversation.